Howdy, Jacob here. Today we're looking at Brightcove. It is in the IT services industry, very small company, 91 million market cap on 68 million enterprise value. For companies this small, I do like to look at their insider ownership, which is about 5.6%, 5.7%. Not terrible. I do like to see double digit, but again, it's just like any other figure. It's never one size fits all. If it's 50%, doesn't mean it's a buy. It just helps your case in creating a story to be able to calculate the present value of future cash flows for a business and to calculate what you think the business is worth. Current PE price to book is 0.9, so that's interesting for a company that's this small. I presume they'd have a lot of growth out of them, but we are seeing the most recent 2 years actually declining growth. Before that, you were seeing a mid to probably upper single digit growth. Even in the last 10 years, average it out mid to upper single digits. They're still trying to find their operating margin. Their gross margin is pretty impressive in the 60% range. Let's see if it's just a lot of R&D or what. Okay, 36 million of R&D. Not a whole lot of increase in research and development. We are seeing an increase, but just nowhere near as much as the revenue increase or sales and general admin, which is fine. But R&D is basically growth you're taking money away from now to have more growth for the future and hopefully better profits in the future. And so even if you just cut that in half, you're looking at about 18 million. They would have profits then. And so it hindered their growth, but they would have profits. So we can see we have sight of profitability. Now we just need the company to actually perform R&D while still producing positive earnings. So they have been diluting, but just not an incredible amount, which is good. You don't want too much dilution of shares. And it might not just be issuance, it might be stock-based compensation. And then balance sheet shows 19 million cash on hand with no short-term debt, no long-term debt, just 17 million in capital leases for their variable debt. And so that's not a concern at all. We're actually looking pretty positive on the balance sheet. And free cash flow we do see is positive, and it's mostly due to stock-based compensation, but there are 2 years over here where their cash from operations still exceeds their stock-based compensation, meaning that it was free cash flow prior to stock-based compensation. And so, yeah, like I said, they're not issuing, or like I predicted, they're not issuing shares down below to just any old people. They're issuing shares through stock-based compensation to their board members, to their CEOs, CFOs, all their people that work at the business. And so that should help increase the insider ownership. And like I said, still producing positive free cash flow is good for the business. And it's pretty consistent with what I see with a lot of IT services and software companies that are a little bit smaller, where their earnings might not be positive yet, but their free cash flow margins are. So I think we're ready to start making some assumptions here. I'm going to say that they do find profitability. They are able to get back to positive revenue growth, and I think that it'll be closer to a 6% range. I think that the margins for them, they're still a very young company. I think that I'll put their margins slightly above average, the market average. And then for a discount rate, maybe just 16%, just a little bit more because it is newer. It's just tough sometimes to value both foreign companies as well as such small companies. And so I do like to have a little bit of margin there before I truly feel comfortable owning the business. And then for margins, I'll probably push the earnings closer to the free cash flow. And I'll say that the free cash flow goes up quite a bit or goes up a little bit more. And so maybe we'll see, let's do 6 and 8%. Oh, that seems pretty ballsy, actually. Let's do, okay, that was 6. Let's do 4 and 6%. And then for share change, they had about 10 million issuance, 13 million issuance. That's looking at about 2% there, which seems to be accurate with their increase of shares the last couple of years. So I mean, really, we're not terribly far off. We're just going to have to, these are the things we're going to want to be comfortable with. Can they get back to mid to upper single digit revenue growth? And can they get back to this 6 to 9% margin? If they can, then I think you're looking at a pretty decent price right now, or it's very close to a decent price to where you'd want to do more research on it, or well, I will do more research on it. But you're really going to need these figures to hold up for your story to really be a good price at this point in time, or 20% down. So I do think good company, smaller companies are tough, but I am more optimistic on them given the fact that they're so small. It's really not hard for a company that makes $200 million a year with their industry being billions of dollars to grow at 5 to 7%. They could be a good acquisition takeover at some point, but for me right now, we are close though, so I will very likely be doing more research on it soon, just not yet. So hopefully enjoy the video and the rest of your day. Thank you.